For the last 2 weeks, people have been telling you what to think about the SpaceX IPO, and the majority of those opinions have not been rooted in facts. So let's talk about how to evaluate it for yourself. I'm Christiana Lovelace. I'm a licensed financial advisor, an accredited asset management specialist, and the owner of Pointe Financial. Each week on Pointe Perspective, we help you make sense of the markets, the economy, and your financial life from a professional perspective, so you can make financial decisions with more clarity and confidence. This week, we're focusing on expectations and analysis. First, we'll discuss the SpaceX IPO, how IPOs typically behave after going public, and why separating facts from emotions remains one of the most important skills an investor can develop. Second, we'll examine the latest economic developments involving Iran, inflation, and the Federal Reserve, while discussing how these events are often more connected than they might appear. And finally, we'll discuss estate planning documents that go into effect before you pass and why these documents can become some of the most important protections you put in place for yourself and your family. Whether we're evaluating an investment opportunity, an economic headline, or a planning decision, good outcomes usually begin by looking beyond assumptions. One of the biggest stories in the market right now is SpaceX. On June 12th, the company completed the largest IPO in history, raising approximately $75 billion and debuting at a valuation approaching $2 trillion. Investor demand was incredibly strong, and the stock surged nearly 20% on its first day. As of filming, the stock has soared over 43%. And that's not surprising. After all, SpaceX has become one of the most recognizable companies in the world. It was always going to attract enormous attention. But what has been more interesting than the stock itself has been the public reaction. If you've spent any time online recently, you've probably noticed that people tend to view SpaceX through an emotional lens. Some people believe it's the opportunity of a lifetime. Others believe it's nothing more than a mechanism for founders, employees, and early investors to cash out. But what's important to understand is that these conversations are not unique to SpaceX. It's a common theme surrounding almost every major IPO. So first, what is an IPO? An initial public offering is the process of taking a privately held company and making shares available to public investors. First, they go through an underwriting process where the company hires investment banks to evaluate its financials and determine a starting price. The company then files a detailed registration statement before the roadshow, which is where the opportunity is presented to institutional investors. This is to generate interest and gauge demand for the stock. The shares are then priced and debuted on a stock exchange, like the New York Stock Exchange or NASDAQ. This process is used to raise capital for future growth, create liquidity for founders and employees, and provide access to public markets. So in other words, yes, early investors often benefit, and that tends to be one of the primary reasons IPOs exist in the first place. And SpaceX isn't the only company investors are watching. Markets continue discussing potential future offerings from companies like OpenAI, Anthropic, Databricks, and several other highly anticipated private businesses. When these companies become public, you'll hear many of the same arguments you're hearing today. Some people will love them, some people will hate them, and a lot of the reactions will have more to do with emotions than fundamentals. One of the biggest mistakes an investor can make is assuming that because they like a company, it automatically becomes a good investment. Or because they dislike a company or its owner, it automatically becomes a bad investment. But investing for your future doesn't work that way. A great company can become a poor investment if it's purchased at the wrong price. And a controversial company can become a successful investment if expectations are too low. That's why you have to look beyond the noise. One of the charts I'm showing today comes from Morningstar, and it tracks some of the largest IPOs. What's interesting is that many of these companies struggled after going public. In fact, among the 25 largest IPOs studied, average returns were negative 1 month later, 6 months later, and even 1 year later. Less than 30% were positive after a year. More than just introducing a company to the markets, an IPO introduces a price discovery process. For the first time, millions of investors begin debating what that company is worth, and that process can take years to stabilize. This is one of the reasons I personally tend to be cautious with IPOs, both for myself and my clients. There can absolutely be opportunities, but I generally prefer to see how a company operates as a public company before committing capital. I want to see how management communicates, understand how earnings develop, and I want to monitor how the market values these businesses once the excitement begins to fade. Those answers take time. The bigger lesson in these events goes beyond any single stock, and it's something you've heard me say every single week. We live in an environment where headlines, social media clips, and viral opinions move faster than ever. But financial plans can't be built on hype or on fear, and they certainly shouldn't be built on memes. If the loudest voices on the internet are making your investment decisions, you're not following your plan, you're following someone else's emotions, and that is not a sustainable investment strategy. The more emotional the conversation is, the more important discipline becomes. These public narratives change much faster than fundamentals, and over the long run, fundamentals are what ultimately matter most. One of the biggest economic stories this year has been the conflict involving Iran and the disruption surrounding the Strait of Hormuz. We've discussed before that a significant portion of the world's oil supply moves through that region, which is why markets reacted so strongly when tensions escalated. At first, we saw a lot of investors shrug it off, but as it continued and concerns increased, oil prices moved higher and investors began worrying about what that could mean for inflation. It does appear that a tentative agreement has been reached, and markets have responded positively to that news. Oil prices have moved lower as investors begin removing some of the geopolitical risk. But this is, of course, all as of filming, because we've seen situations like this before, and until agreements are finalized and implemented, uncertainty will still exist. While lower oil prices are certainly encouraging, it's important to understand that inflation doesn't disappear overnight. We've seen inflation remain elevated throughout much of this cycle, and recent data continues showing pressure from energy costs and other areas of the economy. This is where investors often oversimplify the story. It's not about whether oil goes up or down. The question is whether inflation is cooling enough, consistently enough, for the Federal Reserve to become comfortable changing monetary policy. One thing we've discussed before is that every policy decision creates trade-offs. Whether we're talking about sanctions or tariffs, military intervention, energy policy, or interest rates, there are typically benefits and costs occurring at the same time. That's one of the reasons economic analysis is often more complicated than political headlines make it seem. We can't eliminate every problem at once, so we have to determine which set of trade-offs creates the most stable outcome over time. Right now, the Federal Reserve continues balancing that same challenge. On one hand, inflation remains above target. On the other, economic growth has slowed from its extraordinary post-pandemic pace. Last week, we discussed how the economy remains surprisingly resilient through all of the headwinds. So we're not currently in the kind of conditions that typically force the Federal Reserve into rate cuts. In fact, if inflation remains stubborn and economic activity remains stronger than expected, investors may need to consider the possibility that rates remain elevated longer than originally anticipated. It's also important to remember that policy changes rarely create immediate results. When the Federal Reserve raises or lowers interest rates, the effects can take months or even years to fully work their way through the system. Markets often react first, while the broader economy takes much longer to adjust. And that's one of the reasons investors pay so much close attention to the Federal Reserve communication. June's meeting is this week, and investors will be watching closely for any changes in language surrounding inflation, employment, energy prices, and future policy expectations. The next scheduled meeting is at the end of July. Remember, markets are forward-looking. They're trying to determine where the economy may be heading next. And that's why understanding the connections between geopolitical events, inflation, interest rates, and economic growth remains so important. Nothing happens in isolation. A geopolitical event affects energy. Energy affects inflation. Inflation affects interest rates, and interest rates affect everything from businesses and consumers to markets and economic growth. The more clearly you understand those connections, the easier it becomes to evaluate headlines within the context of the bigger picture. As we continue our discussion around estate planning, we're moving from preparation into implementation. Last week, I encouraged you to begin organizing your assets, reviewing beneficiaries, documenting your wishes, and identifying the people you trust to help carry those wishes out. This week, we're focusing on 3 of the most important documents that become effective while you're still living. That's a financial power of attorney, a healthcare power of attorney, and an advance directive, or sometimes called a living will. Technically, these documents can often be created without an attorney, but there is specific language and documentation required for hospitals, financial institutions, and other organizations in order to recognize and implement them appropriately. The first document is a financial power of attorney. This allows someone you trust to make financial decisions on your behalf if you're unable to. That can include paying bills, managing accounts, signing documents, and handling other financial matters. One misconception I hear frequently is that a spouse automatically has access to everything. And in many situations, that simply isn't true. Without proper documentation, even a spouse can be denied access. And depending on your state or the type of transactions involved, this document may need to be recorded with the Register of Deeds before it can be used in certain situations. Next up is a healthcare power of attorney. This document allows someone to make medical decisions on your behalf if you're unable to communicate those decisions yourself. And while hospitals do have procedures for determining decision makers when no documentation exists, the person selected through that process may not necessarily be the person you would have chosen. Along with that, many people also choose to complete an advance directive or a living will. This document helps communicate your wishes regarding medical treatments and end-of-life care, which can include life support, feeding tubes, ventilators, and other medical interventions. This can help to reduce the burden on your healthcare power of attorney by providing guidance regarding your wishes and allowing you to maintain greater control over those decisions. As you make these decisions, you want to be very intentional when it comes to choosing the proper agent. Some people default to their spouse and then their kids, but if your children are not good with their finances, or maybe they struggle with substances, you don't have to select them. You can choose a sibling, a close friend, or another trusted individual, but I would not make this decision lightly. These roles often involve significant authority over your finances or healthcare decisions, so you want to be confident that they will act in your best interests. Along with that, you need to have a conversation with them. You want to make sure that they're comfortable serving in that role and that they understand the responsibilities that come with it. I know these conversations aren't always comfortable, but they often provide clarity during some of the most difficult times a family may face. At Diamond Point Financial, we help clients implement these planning tools as part of their broader financial plan. We offer access to estate planning resources while coordinating those decisions with the rest of your financial life. Preparing your estate plan can help make difficult situations a little easier for the people you care about most. Next week, we'll continue this discussion by focusing on wills, trusts, and how assets are ultimately transferred to the next generation. Today, we discuss the importance of separating facts from emotions, how economic events may influence policy, and why estate planning isn't just about what happens after you're gone. If this discussion helped bring some clarity to what you're seeing in the markets, in the economy, or in your own financial life, make sure you subscribe to our channel for new discussions every Thursday. Or if you'd like a more concise breakdown, you can subscribe to our weekly newsletter. And if you have questions about your own financial situation, you can learn more about Diamond Point Financial using the information below. I hope this offered some useful perspective, so until next week, take care.